Okay, tax students, here in Chapter 7, let's take a look at corporate distributions that are not going to stop or liquidate the corporation. Sometimes we call this dividends, but we'll see distributions can be dividends and maybe something else. So let's have our corporation down here. And of course, we have to have at least one shareholder, could be more, could be thousands. And when the corporation distributes money or other property to the shareholder, that's called a distribution. But let's treat it as a dividend for now, keeping in mind that when the corporation receives income and makes a profit, it has to pay taxes on that profit. It's a tax-paying entity. So here's the tax going to Uncle Sam or other government entities. And when the shareholder receives this dividend, the shareholder has to pay a tax to the government. So that's why they call this double taxation, because this initial profit down here gets taxed once to the corporation and again by the shareholder. The corporation cannot deduct this dividend payment to the shareholder like other payments as expenses. Now let's say that the person that is the shareholder has other relationships with the corporation. For example, if the shareholder, in addition to investing money with the corporation, also lent money as a loan, and he went through all the formalities like creating a promissory note that set an interest rate and a term limit. So now when the corporation pays this same person, but now in the capacity of a lender, what we're paying is interest, which is also taxable to our shareholder lender person up here. And of course, they're going to be paying taxes to the government. But now our profits are going to be reduced because the corporation can deduct this interest, and that's going to reduce the corporate tax liability down here. Unlike a dividend, again, a dividend you cannot deduct to reduce the corporate profits. Or maybe the same person up here that's the shareholder or the lender is also a landlord that owns the property where the corporation is running their business. So now the corporation has to pay rent to that landlord. And of course, the landlord has to pay taxes on this rent, but the corporation can deduct that rent, reducing the profit, reducing the taxes being paid to the government. So again, that's going to eliminate any double taxation. Now, the ultimate situation where this shareholder is also receiving money from the corporation in a different capacity is when the shareholder is also an employee that's earning a wage or salary. So now when the corporation pays that amount to that person in the capacity of an employee, that's going to be subject to tax, income tax, maybe even the Social Security and Medicare taxes. But the corporation can deduct that, reducing the profit again and reducing the amount of taxes being paid to the government. Maybe another payment for the benefit of this shareholder, lender, landlord, employee, really in the capacity of an employee, is if the corporation sets up, let's go back here, sets up a retirement plan, like a pension plan or a 401k plan, and the corporation will contribute, that's the term we use, funds into the retirement plan, and the corporation will be able to deduct that, reducing the profits and paying less taxes. And the money here in the retirement plan is being invested, and the earnings are not tax-free but tax deferred, postponed until hopefully the employee retires and gets into a lower tax bracket and pays taxes on this distribution, retirement distribution. Okay, so this is the different capacities an individual can be related into with a corporation. Keeping in mind the one we're focusing on here is as a shareholder employee. But again, you can see there's different options of maybe getting money to that one person. Again, we're focusing on distributions from the corporation to the shareholder, and it'll be treated as dividend income, and we'll see that's only to the extent the corporation has earnings and profits, which we'll calculate later on. But once the earnings and profits are used up and you're still giving distributions to the shareholders, that excess distributions are considered to be returning the investment back to the shareholder. So that's going to be non-taxable or tax-free, at least to the extent of the shareholders' cost basis, tax basis in their investment in their stock with that corporation. Now, once that's all used up, anything extra distributions they get, that's going to be a capital gain. And it's going to be long term if the stock was held for more than a year, or short term if the stock was held for a year or less. We're going to focus on, let's say, on the dividend distribution here. Okay. Well, we will focus on all three. Let's illustrate that here on a blank screen. So again, we have a corporation owned by one or more shareholders. And again, we're giving a distribution from the corporation to the shareholder. And if to the extent that distribution, let's put it here, distribution is equal to or less than the earnings and profits. Sometimes we kind of call this retained earnings in the financial accounting class, but in the tax class we call it earnings and profits. And to that extent, that distribution is considered to be a dividend. And in the case of an individual receiving qualified dividends from a corporation, this dividend is not taxed at the regular graduated rates of individuals, but could be taxed as low as zero if the other income of the shareholder is relatively low. Again, we're talking individual, people like you and me, with relatively other low income. The dividend can be taxed at zero, although for most taxpayers, they probably fall within the 15% qualified dividend rate. And for those taxpayers in the high tax bracket, their dividend is not taxed at the high marginal rate of 35%, but taxed at 20%. Okay, that's the high rate for dividends. Keeping in mind that we had learned back, I think it was in chapter 4, there was something called a net investment income tax. For high bracket taxpayers, their investment income may be subject to another 3.8% to help fund the Affordable Care Act. So again, if the dividends fall within the earnings and profits of the corporation, that's a dividend. Now, if we go over that earnings and profits, any excess is going to be tax-free up to the amount the shareholder had invested in their stock, either investing with the corporation or maybe they bought their shares from other shareholders. Whatever they had paid for those shares, that's their cost basis, and they're going to recover that tax-free. Now, once they use up all of that tax-free tax basis, any excess over the basis is going to be a capital gain. And maybe you learned in the previous tax class, long-term capital gains, long-term, not short-term now, is taxed at the same 0, 15, or 20% rate and may be subject to the net investment income tax of 3.8%. Okay, so that's individual shareholders. So let's say our shareholder now is another corporation and they're receiving a dividend distribution. As we had seen, I believe back in the previous chapter, you got to report all of this dividend income, but you also get to deduct a dividend received deduction depending upon how much of the owning corporation, percent ownership they have in the invested corporation. So the amount of the dividend received deduction generally is something like half of the dividend, or 65%, I believe, of the dividend, depending again how much of this investor owns in the investee. So if you're a corporate shareholder, maybe you like dividends, not the tax-free one here to recover your basis, or the long-term capital gains, which is going to be taxed at regular rates for a corporation. You like dividends because of the dividend received deduction. Okay, so we're focusing on dividend income, not the tax-free recovery of tax basis or the excess tax at long-term capital gain. The distribution is going to be a dividend to the extent of the corporation's earnings and profits. And it's comparable to, in financial accounting, the account that you had learned called retained earnings. Of course, retained earnings was based upon GAAP rules, and earnings and profits are kind of like tax rules, but slightly more leaning in between tax and financial accounting rules. So we'll see the adjustment to get to the earnings and profits amount. Now, earnings and profits, or retained earnings, if you want to use the financial term, is split into two different parts. You're going to look at the earnings and profits for the current year. Really, this is the company's net income for the current year. Revenue minus expenses. And the retained earnings, or the accumulated earnings and profits from previous years. Keeping in mind that just like retained earnings up here, if you had a net loss for the current year or past years, that would reduce retained earnings. If you had paid out dividends or declared dividends in past years, that would have reduced retained earnings. So this accumulated earnings and profits is not just all the net incomes of the previous years, but it was reduced for net losses for previous years. It was reduced by dividends paid out from previous years. So really what we're looking at is the beginning of the year, let's say calendar year, January 1st, 2019. What's in the retained earnings account? That's going to be your accumulated earnings and profits. And the current earnings and profits is just the profit, the net income for the whole year. Okay, so you gotta split up that retained earnings, or the earnings and profits, for the current year and all of the previous years from the beginning of the current year. So why don't we kind of analyze this using debits and credits. Hopefully something that you remembered from your previous accounting class. So you remember, you remember the chapter, or the topic of declaring a dividend. Remember, you have to say that you're going to pay out a dividend in the future, so that's the declaration. Then you have to own the dividend as of a certain date. And if you own it, eventually you're going to be paid later on. Okay, so that's really what you guys learned in the prior accounting classes. Maybe another thing you learned was you gotta have retained earnings. If you don't have retained earnings, maybe you cannot declare a dividend. Also, you have to have some property. Usually it's cash to pay out. So if you don't have any cash or any property, there's nothing that you can distribute to your shareholders. So let's take a look at that retained earnings account. So if you remember, this is a equity account. Equity accounts are increased with credits. So let's say we already have in here $100 million of retained earnings or uh, accumulated earnings, and this would be the beginning of the year balance. And then during the year, we made money, so that's the revenue. Revenue is also increased with credits. Let's say 300. And then during the year, we incurred expenses. Expenses are recorded with debits. Let's say 100. So once the year's over, we would close out the temporary accounts. That's revenue and expenses. So we had an account called, some people use an account called income summary, where we would close out the revenue by putting in debits, and the offsetting credit goes into the income summary account. And the expenses are closed out with credits, and the same amount is offset by putting a debit in the income summary account. So these are closed out here, right? And all we have left is the income summary. And the balance in here, if it's a credit balance, in our case 200, this is your company's net income. And you would usually close it out into the retained earnings. But keep in mind, we want to separate the current year's earnings from the prior year's accumulated earnings. This 200 is current earnings and profits. This 100 is accumulated earnings and profits. And the rule is you use the current earnings and profits first when you have a dividend for tax purposes. And then you use the accumulated. Okay? So you don't mix up the two and then you say you have a dividend. So if you remember, there was maybe a dividend account called dividends payable or dividends distributable. Eventually, you're going to be crediting the cash account when the cash goes out. So let's say you pay out 50 as your dividend, credit cash. The offsetting debit isn't over here to retain earnings. That's the old accumulated. You gotta start using this up first. Okay, so here 50 of that 200 of current earnings and profits is the dividend. And as long as you have current and accumulated earnings and profits, any distribution you pay out is treated as a dividend versus a recovery of the cost basis of the shareholder's investment versus a excess for capital gain. Okay, so now what you have left, let me close out this 200 and then this 50 here. So that should leave us 250. So this is going to be the beginning balance for next year. But again, next year you got to first look at the current earnings and profits, and then look at the accumulated earnings. The accumulated earnings and profits account can only be reduced below zero if there's a net loss. If you try to make a distribution and it goes below zero, technically that's not a reduction of the retained earnings or accumulated earnings and profits. In other words, it cannot go below zero when you make a dividend distribution. It can go below zero if you have a net loss over here. Okay, so let's convert our current net income, or here the starting point in our textbook is taxable income, and we're going to see there's adjustments to make it into current earnings and profits, the current net income figure. And again, it's more like financial net income versus taxable income when we make these adjustments. So the adjustments are divided up into four categories. Here it says to include income that was tax-free. So this is going to increase the taxable income, make it bigger to get to the current earnings and profits figure. Here it says disallow some deductions that do not require an economic outflow. So when you disallow a deduction, let's start this off here. Revenue minus deductions equals the taxable income. So if you disallow deductions, you're reducing deduction and increasing the taxable income. So this adjustment is going to increase the taxable income. An example we'll see is the dividend received deduction. It doesn't require you to pay out any money, but it's just given to you automatically when a corporate shareholder receives a dividend. Okay? They're making a deduction out of thin air without any cost going out. So that's disallowed. So that's going to increase the taxable income. Here it says deductions, certain expenses that require economic outflow. That means money is eventually being spent, but you weren't able to deduct it to get to taxable income. So that's subtracted out to make the taxable income smaller. And this last one, if you remember the timing differences, the temporary differences in the previous chapter, in the initial year, it could either be increased or decreased. But in the subsequent year, when the item turns around, then the opposite would happen. You would have to decrease if you had increased initially, or you have to increase if the initial transaction was to decrease. Okay, so we'll see examples of that also. So the first one we'll look at is this one, to add in tax-free income. So examples of tax-free income was the municipal bond interest, the life insurance proceeds. When you receive a federal income tax refund, it's not taxable, but you add it in to get the current earnings and profits. The last one is more like the concept of comprehensive income, where you're looking at something equivalent to cash. So you have something called cash surrender value with a life insurance policy, and if it's increasing, you have more liquid funds available to pay out dividends, so that's going to increase your current earnings and profits. Here we're going to reduce deductions that didn't have any cash being paid out, like the dividend received deduction. So that's going to, if you back this out, that's going to increase taxable income. And then artificial deductions that were excess amounts from prior years. An example was net operating losses. You don't carry back anymore, you just carry forward, yeah? So that would be really deducted back in the year that the loss incurred. But now when you carry it forward and deduct it, that's an artificial deduction. So we back that out to increase taxable income. Same thing with net operating loss carry forwards. We back it out to increase taxable income. Same thing with carry forward of unused charitable contributions. It should be deducted in the year incurred. So when you carry it forward to the current year, you back it out to increase taxable income. So here's some deductions that were disallowed, but now economically you're paying out the money, so you should reduce your taxable income to get to the current earnings and profits. Federal income taxes, that's what we're trying to calculate, but you cannot deduct that for taxable income. But for earnings and profit purposes, we subtract it out. We saw that tax-exempt income was added in, and if you have expenses related to that, for tax purposes, you couldn't deduct it, but now you do for earnings and profit purposes. You know all the charitable contributions? If you were limited on the tax return, well, you deduct the whole thing now that you had paid out or incurred for the current year. Life insurance premiums you pay out weren't deductible. Well, now they are for earnings and profit purposes. Excess capital losses, remember you only can use them to the extent of capital gains, but for earnings and profit purposes, any losses you incur this year, you subtract them out. And this is more of a timing difference here. Earnings and profits depreciation. Well, tax depreciation, we know there's makers, bonus depreciation, section 179. Earnings and profits depreciation, you calculate it using a straight line and a life called alternate depreciation system. A little bit longer life than the life under the maker's method. So that's gonna, let me think now. Initially, the regular depreciation should be bigger, yeah? But here it says now it's turning around in a future year, probably, so we're going to be reducing that taxable income to make the earnings and profits smaller. Government penalties and fines you can't deduct on the tax return, but for earnings and profits purposes, we subtract it out. Some more things we subtract out. If you remember, the current rule for business meals is that you get to deduct only 50% on the tax return. But now the rest of the business meals you get to deduct. So another 50% subtracted out. Entertainment expenses, nothing deductible anymore on the tax return. But for earnings and profits purposes, you deduct the whole thing. Same thing with lobbying, political contributions, not deductible, earnings and profits deductible. Let's see, so this is the turnaround here when cash surrender value decreases, again, less funds available, that's all subtracted out to reduce the taxable income to get to the earnings and profits. The next type of adjustment, again, is those temporary differences, which could either be plus or minus to the taxable income. So this is just postponing the taxable income, but for earnings and profit purposes, you recognize the whole gain at the point of sale. You recognize the whole gain when you finish the contract. Well, actually, over the period in which you earn, probably percentage of completion method versus completed method. Let's see what else. Let's go to the next page. So again, some of these could be added or subtracted. Maybe one of them that you'll see on the Learn Smart practice problems is this one here. Section 179 pretty much allows us to deduct the whole amount of a depreciable asset in the first year. But for earnings and profits purposes, you have to take straight line for that type of eligible asset over a 5-year period. So if you deduct it over 5 years, that means you cannot deduct 100%. You only deduct 20% of the cost of the asset, meaning that you're increasing that taxable income by 80% of the cost of the asset for that first year, and then reducing taxable income by another 20% in future years. Okay, so we got current earnings and profits, and we got prior years accumulating earnings and profits at the beginning of the current year. And there's no question, or it makes it real easy if both figures are positive. That means probably all the dividends you pay out during the year, to the extent of all the earnings and profits, going to be treated as a dividend versus recovery, tax recovery of cost basis or excess capital gain. Or here, all of the accumulated earnings and profits and current is negative. Okay, so if you make a distribution out of the current year, it's going to either come from cost basis, tax-free, or excess over that, treated as capital gain. The harder one is when either one is positive and the other is negative, or the other is negative and the other is positive. So our textbook goes through examples of all of these different situations. Okay, so let's just go through a couple of the simpler ones here in this slideshow. So current, that's the current year's taxable income as adjusted for those adjustments we went through, is $1,000,000. But in past years, all the way up to the beginning of the current year, the retained earnings or accumulation profits is a deficit, negative. Again, keeping in mind, distributions cannot reduce this below zero. So it's already below zero. The only way you can get it below zero after that is if you have losses, net net losses on your annual corporate year. Okay, so we're told now there is a distribution of $1,000,000 right at the middle of the year. So the question is, how much of this distribution is going to be treated as a dividend? Keeping in mind, the first place you look to determine whether your distribution is a dividend is the current year's earnings and profits. You don't mix it up with the prior year. And because we have enough current year's earnings and profits equal to the distribution, all $1,000,000 of the distribution is considered to be a dividend. Okay. Now, if you had paid more than $1,000,000, the excess would be recovery of the cost basis, because again, you only have this amount of earnings and profits. Anything in excess of the cost basis, capital gain. Example number 2. Now, current earnings and profits, we have a current loss. But at the beginning of the year, we have a positive balance of $1,000,000 in our retained earnings or accumulated earnings and profits. And the distribution is still right in the middle of the year. Now, because we don't have any current earnings and profits, we're going to have to allocate how much of this loss happened all the way from January through the time we made the distribution, which is half a year, and we assume it's half equally earned throughout the whole year. So half of this profit, $500,000, was earned up to the time the distribution was made. And let's see, sorry. Half of this loss was incurred from January to July 1st. Okay, that's a loss. And that's going to offset the accumulated earnings and profits on the beginning of the year, leaving us $500,000 of current earnings and profits when this distribution was made. Okay, we distributed $1,000,000, but at that point, we only had $500,000. Again, we're allocating this whole year's worth of loss up to half a year. So that's going to reduce the accumulated earnings profits at the beginning of the year down to $500,000. So $500,000 is going to be treated as a dividend. And the excess, again, recovery of the cost basis of the taxpayer, the shareholder, and any excess over that, capital gain. So what is the amount of the dividend? So it's easy if the only thing you're receiving is money. Yeah, $1 of money is $1 dividend. But if you're not receiving cash, then other property, you gotta look at their fair market value. Sometimes the property could be real estate, and we know real estate typically is purchased, in this case by the corporation, with a mortgage. So there could be a liability attached to it that the person receiving the property has to assume, or is going to agree to assume. So if the person getting the property does assume the liability, the mortgage, you're going to reduce the amount of that distribution. So adding it all up, the money you got, the value of any other property you got, minusing any liabilities attached, and the shareholders assuming is going to equal to the distribution, be it treated as a dividend or recovery of costs or excess capital gain. So what's the consequences now to the corporation that's paying out a dividend that's not cash? The corporation may have to recognize a gain equal to the value of that property in excess of the corporation's tax basis, cost basis over that property. Okay. In the case where the liability being assumed is bigger than the fair market value, then the gain is going to be the amount of the liability in excess of the cost basis. Again, that excess is the gain the corporation will have to recognize. So example, our shareholder receives property from Sunny Corporation. The value is 200. She's going to assume a mortgage of 100. And the cost basis to Sunny Corporation is 100. So value minus the cost basis is going to equal the gain Sunny Corporation has to report. Now, what is share going to report as a dividend? Assuming there's sufficient earnings and profits, she has the value, no cash, right? Just the value of the property, minus the mortgage, or her dividend would be 100 also. Example number 4. This time, the value is 200. The mortgage is bigger, 300. The basis of the property to the corporation is still 100. So this time we're saying that the sales price is the higher, the mortgage. Minusing out the cost basis gives us a gain the corporation has to report of 200. Let's stop here, and in our second video we'll talk about stock distributions and stock redemptions.